Hey guys, I hope you all are doing great. Welcome to the next episode of the Audit Practically series. Today, yet again, we're going to be seeing a very important financial statement line item, again, which requires you to apply a bit of your mind. Yep. So, welcome to Accounts Payable, guys. Again, a financial statement line item that requires you to think analytically a bit out of the box as well, and also requires you to apply a bit of laws and regulations as well. So, what are you waiting for? Let's jump on to Accounts Payable, guys. Just give me a moment. I'm just presenting my screen and let's just hop on to the financial statement line item, guys, and discover content that's worth gold. So yes, here we are, guys. Just a moment. I presume my screen is visible. Perfect, guys. Yep. So first, as always, the drill goes. We start with the lead, the grouping, the subgrouping. So the lead, which basically appears on the face of the financial statements, will be bifurcated into MSME payables and non-MSME payables, guys. So MSMEs are basically micro, small, medium enterprises, which we will again discuss as a part of our discussion as we move ahead in detail. Yeah, and your subgrouping, in your subgrouping, basically you will have your GL codes like 8010 or 26010 or 281010, and all that will add up to your grouping, which will basically be your aging, which will be presented in the notes to accounts, and your grouping total will add up to your lead, and your lead will be bifurcated into MSME and non-MSME, guys. And again, if you want to understand the concept of lead, grouping and subgrouping in detail, I've explained it as a part of the OPEX video above, guys. You can hop onto that video and check it there. It's a very elaborate explanation that's been already given there. So for the paucity of time and for an insightful discussion, I'm not going into that again. Yeah, so let's just move down, guys. So just coming down. So there are some general checks you need to do in accounts payable, guys. First, before that, let's just understand what are accounts payable. So accounts payable are basically a creditors which you studied in accounts, guys. Basically, when you purchase goods or when you avail services from a creditor, they are basically your accounts payable. And when payment to them is due as on the balance sheet date, they are regarded as accounts payable, guys. Very simple. It's as simple as that. So what we basically need to check is ensure that advance to suppliers and trade payables are knocked off appropriately. Guys, if you're someone who's already seen my PPE video, there was a similar concept for capital advance and capital creditors, but nevertheless, I will just explain this again. So basically, let's say we give an advance of rupees 100 to XYZ Limited. The entry that we'll be passing in our books is advance to XYZ Limited debit to the extent of 100 to bank account to the extent of 100. Right? Perfect. So what will happen is, let's say we purchase subsequently to the extent of 120. We will pass the entry purchase account debit 120 to XYZ Limited 120. So in your financial statements, you will be showing advance to suppliers to the extent of 100 under your other current assets, and in your trade payables you will be showing 120, guys. But do you think this is the right picture? Do you think this is the way to present it? No, guys, this is not the right way to present it, because you're inflating your asset and you're inflating your liability as well. So this shouldn't be the way it is ideally presented. So the correct entry which we should ideally be passing for the entry of purchases is purchases account debit to the extent of 120. So the debit is fine, and to the extent of 100 credit to advance to XYZ, we first have to knock off the advance. Then we have to create a trade payable to the extent of 20. So the entry ultimately net which we will be passing is purchases debit 120 to advance to XYZ 100 to XYZ limit 20. Perfect. Yes, guys. I hope this is clear. So basically now what will happen is, in our financial statements, as of the balance sheet date, we would not be having an advance to suppliers balance. We will only be having a trade payables balance to the extent of 20, guys, which is what I've highlighted here. And I hope that is very clear. Yeah. Just moving on to the next one. And so the trade payables don't contain creditors for capital goods, because they should be reclassed to capital creditors and shown under other financial liabilities. Guys, your capital creditors are the people from whom you procure your equipment that is necessary for usually constructing a machinery. They are not your trade creditors, because these are in relation to your capital development. So these are not in your ordinary course of business. Yes, they ultimately help in benefiting your business, but they are not directly attributable to your ordinary business activities. So these should not be presented in trade payables, and these should be clubbed under capital creditors. And the discussion surrounding capital advances and capital creditors, again, we have made an elaborate discussion on this as a part of Audit Practically PPE video. If you want that, you can check it out above in the link. And that is also an insightful video, guys. You definitely need to check it out. Yep. So next, we'll come to a testing strategy in relation to accounts payable, guys. How do we need to test our accounts payable? Very simple, guys. So basically what will happen is, your client will give you a dump from their accounting software. It might be SAP, it might be Tally, preferably SAP. I'll explain from an SAP standpoint, because most likely you will be working on SAP clients. So what will basically happen is, this is the format in which you should ideally be documenting in your work paper. So there'll be the serial number. Let's say there are like 1,000 accounts payable line items, you will maybe end up selecting 10 line items. So serial number is like basically item number 1, item number 2, so until item number 10. Document number as per listing. So what is the document number using which the entry has been passed in your accounting software? Then your party name, that is your creditor's name. Description of service or goods. Let's say the same is in relation to purchase of raw materials. Like let's say purchase of gearbox. Then in your description of goods, it would be purchase of gearbox, that is raw material. Or let's say it's a description of service. So it would be service provided in relation to housekeeping or something like that. And amount. So what is the amount of the service or amount of goods that the entity has availed from the creditor? Then your invoice number, invoice amount. Then your PO number, PO value. And your GRN number, GRN value. Or if it's a service that is being availed, it would be a service entry number and service entry value. So then what would happen is subsequent clearing details. So what would happen is as on 31st March, the amount would be outstanding. That is obviously why it is coming under trade payables. Then after 31st March, let's say 1 month into the audit, ideally the amount has to be cleared at the time you come for the audit or in the course of your audit. If the amount is still remaining during the course of your audit, you need to get an understanding of why the amount is remaining outstanding. Is it because of a dispute? Because if it's because of a dispute, you have to show it under disputed payables in your Schedule 3 disclosure. That is of great relevance there. And then you have to see that the due date as per the listing matches with the supportings and if aging is done properly. Guys, in Schedule 3, you have to do an aging for your trade payables, guys. So you need to, so there will be a due date in your SAP listing, which will be based on your PO terms. So what you basically need to check is, let's say the due date for a particular invoice is 30th April. Let's say you also need to compare the same with the invoice and PO to ensure that whatever is there in your SAP dump or whatever is there in your accounting software dump perfectly ties out to the supporting documents as well. Because this is the heart of your aging, guys. Because this is the base which you use to compute your trade payables aging. I hope it is very clear, guys. Next for GRIR. So guys, you all know what is GRIR. So I again explained the concept of GRIR in the Audit Practically series of OPEX, which was our first episode in the Audit Practically series. You can check it out there. So I don't want to be again coming to this here. So basically GRIR is a transitory account, guys. It's a temporary account if I have to give you a perspective. So initially when you book an expense, you will pass the entry expense account debit to GRIR. Then your GRIR account would be debited and your trade payables would be credited, thereby facilitating a movement from your GRIR to your trade payables. I hope it's very clear, guys. This was a very basic gist. If you want the detailed explanation, you can go to the audit of OPEX video and you can find a lot of clarity there. Yeah. So basically you will have to check these things for GRIR as well again. And in addition to that, what you need to check is subsequent invoicing. Like basically as at March 31, the scenario would have been like the entry expense account debit to GRIR was already passed. Then ideally the entry GRIR account debit to trade payable has to be passed. You need to see if it is passed during the course of your audit. If it is still not passed during the course of your audit, you need to understand the reasons as to why the entry GRIR account debit to trade payables is not yet passed. Because GRIR is ideally a transitory account. So the amount needs to get pushed to accounts payable as soon as possible and at a very, very early stage. You need to understand why it is not happening and if it amounts to a control lapse, right? I hope you understood this, guys. And next, let's come to the aging format as per Schedule 3, guys. So this is how your aging as per Schedule 3 would look. Unbilled, not due, less than 1 year, 1 to 2 years, and greater than 3 years. Guys, a very, very important thumb rule, just coming down below to show you this. Aging should be done on the basis of your due date and not the invoice date. So basically, you have to take your due date and compute the aging, guys, and not your invoice date. This is very important. So ideally, some of you might be having a doubt as to what would come in each of these buckets. Let's take unbilled, for example. What would come under your unbilled bucket? Very simple, guys. Under your unbilled bucket, what would ideally be coming is your GRIR balances would be coming under your unbilled bucket, because ideally the amount is sitting in GRIR because the invoice has not been received. That is why it is sitting in GRIR, right? So it will be coming in your unbilled bucket, in your not due bucket. Okay, so what would come in your not due bucket? Let's say you availed a service from a vendor on 30th March 2025. Let's say the credit term is 30 days. So ideally your due date would be 30th April 2025. So as on March 31, 2025, this amount is not even due in the financial year 24-25. It is ideally due in the financial year 25-26. So that amount which is due on April 30th, 2025 would be coming under not due bucket. I hope that is very clear, guys. And similarly, you have to compute for less than 1 year, 1 to 2 years, 2 to 3 years, and greater than 3 years. Ideally, you should not be having any amounts in the 2 to 3 years bucket and greater than 3 years bucket. If that is the case, you need to understand from the client if the same needs to be taken to disputed in your Schedule 3 aging, because your Schedule 3 prescribes the same. And if the amount is outstanding for greater than 3 years, you need to understand the reasons for the same. And if the vendor is not claiming the same from you, you need to check if a write back of the amount is possible. That is basically basically debiting your trade payables and crediting your P&L. That is treating it as an income. So you need to understand whether that should be done, because if the vendor is not claiming, there is no point in keeping it under your trade payables, right? I hope you understood this, guys. Next, let's just come. And as I said, reperform aging on sample items to ensure if the due date as per listing actually ties out to the due date as per your supportings. That is your purchase order, your invoice. Yeah. And understand the reasons for long overdue items and understand if the same ought to be moved to disputed, because Schedule 3 requires you to do the same. I hope that is very clear, guys. So basically in accounts payable, it is almost similar to the columns you had in your operating expenses testing, right? Yeah. So that is what we basically do, guys. And here, this is my favorite part. This is a very beautiful part, which I love. Audit of MSME payables, guys. So this requires a bit of knowledge about the MSME Act, a bit of knowledge about the procedures you need to do here. So I'm going to cover this one in a really, really understandable manner for you guys. So what are you waiting for? Let's move on, guys. MSMEs, micro, small, and medium enterprises, guys. So basically, as I told you earlier, in your phase of financials, you will be splitting your trade payables into two: one MSME, two non-MSME. So basically, you need to first see. So for that purpose, you need to ensure that whatever is going under the MSME number is correct, because that is appearing on the face of the financials, and you cannot afford to get it wrong, right? Perfect. So you have to select sample vendors classified as MSME by the management. Basically, the client will give you a listing where you will say that, boss, there is 100 of trade payables outstanding, out of which 40 pertains to MSME vendors, 60 pertains to non-MSME vendors. So in that 40, you have to take sample vendors and you have to see whether they are actually MSMEs. Because if it's a case where only 30 is actually MSMEs, then ideally the amount in non-MSME should be 70 and the amount in MSME should be 30. So it would warrant a change in your disclosure. So this is very critical, guys. So you need to check the MSME certificate granted by the government of India to check their actual status. And another thing which you can actually do out of your own interest is, suppose if these MSMEs are companies, you can go to the MCA portal, look at their financials, and if they are within the threshold for the MSMEs. And you can also do this sense check also for samples and ensure that they are actually MSMEs and that the disclosure is correct for sample items. So basically, there was an amendment in the classification of MSME with effect from financial year 25-26, guys. I will also explain that here. So if your investment is less than or equal to 2.5 crores, and if your turnover is less than or equal to 10 crores, it's a micro enterprise. And if your investment is less than or equal to 25 crores and turnover is less than or equal to 100 crores, it's a small enterprise. And for a medium enterprise, your investment should be less than or equal to 125 crores and turnover should be less than or equal to 500 crores. Both of these are cumulative conditions, guys. Both these need to be satisfied. It should be within the investment limit. It should be within the turnover limit. Both these need to be satisfied. Just keep that in mind and check accordingly, right? Yeah. Basic understanding of MSME Act, guys. So yeah, let's just come here. So let's say there is an entity, that is the entity which we are auditing, who is our audit client. They are procuring goods or they are receiving services from the MSME vendor. So we need to check their agreement. Let's say they have an agreement between them. Let's say the credit period is agreed. So the credit period which they can maximum agree is 45 days from the date of acceptance. And let's say they do not agree on a specific credit period. So then in such a scenario, there should be a maximum of 15 days from the date of acceptance. Assuming that the entity we are auditing does not make any objection to the goods or services received. So the day on which the entity does not make any objection, that is the date of acceptance in this case, guys. So this scenario won't practically arise because your credit period would be agreed beforehand through your PO or through your invoice, guys. I hope that is very clear. So let's say the credit period agreed is 30 days and the amount is not paid by the entity till 30th day. You guys would have a doubt. Is this a delay, boss? Yes, this is a delay because the MSME Act says that the maximum credit period you can have is 45 days. But it is just the maximum limit. Here, you have agreed for 30 days and you have not paid on the 30th day. So it would amount to a delay, guys. And so basically, in the crux is that it is either 45 days or the credit period, whichever is earlier. I hope you understood this, guys. So it would amount to a delay in payment. So you need to understand what are the consequences of delay. What are the consequences of a delay in payment? Guys, let me break this down. So let's say there is a delay in payment to your MSME vendor. In such a scenario, you would have to accrue interest in your books of accounts. So at what rate would you need to accrue this interest? Guys, it's very simple. The interest on delay would be 3 times the bank rate. So the bank rate is the rate which is prescribed by RBI, guys. When you go to RBI official website, you can find it out. And this should be compound interest, guys. Very, very, very important, because Some clients, what they do is they accrue at simple interest, which is not right. You need to ensure that this is at compound interest. That is very important. And the amount will tend to be higher because it's compound interest, because it involves compounding, because your principal is getting churned again and again. So that is the case. So as on March 31, 2025, the bank rate was 6.5%, guys. You can trace this to the RBI website. In case you're not able to find it, let me know. I'll also reply to you guys in the comments with the link of this. So 3 times the bank rate. So basically 6.5% into three times, which would amount to 19.5%, right? Perfect, guys. So how do we calculate this interest? How do we recompute the interest which the management has calculated? Very simple. So for trade payables, you need to get 2 listings from the management. First, your outstanding payable balances. Like how much is outstanding? Let's say 100 is outstanding. You need to get the invoice-wise breakup for this 100, right? Perfect. And let's say out of this MSME's amount to 40. So you need to get the invoice-wise breakup for that 40, guys. Perfect. So then you need to calculate interest for that 40. Perfect. This is in relation to outstanding balance. But guys, let's take a scenario where our credit period agreed was 30 days. But let's say we settled on the 32nd day. Here again, there is a delay of 2 days. You might have a question, boss, do we need to accrue interest in this case? Yes, guys, even though the amount has been settled during the financial year, interest needs to be accrued even on these amounts. That is very important, guys. Again, this is something which clients miss to do. They only accrue on the balances that are outstanding as at the year end. This, again, you need to be very skeptical about this. So if I just come here, what you have to do is you can take during the year transactions dump. Basically in SAP, you can take from the date transaction, that is from 1st April 2024 till 31st March 2025 using your FBL3 and T code or your FAGLL03 T code, guys. So again, this will be provided to you by the client. So basically, in this dump, what will happen is the entry that will ideally be passed is your trade payables will be debited and your bank account will be credited. So ideally, the entry would be trade payables account debit to bank. That is the entry that would be passed here, guys. So what you need to ensure here is, guys, and this would be one dump. And other than this, during the year dump, your payments would also come. Apart from this, the entry which you pass as on GRIR account debit to trade payables, that would also be in this dump. So in this during the year dump, there would be 2 transactions that would be coming here. One would be GRIR account debit to trade payables. The other would be trade payables debit to bank. So guys, what would happen is, since all the amount would not have been cleared, let's say the entry passed in relation to GRIR account debit to trade payables comes out to let's say 40, and let's say the trade payables debit to bank amount comes out to let's say 30. So if you see here, there is 10 that is still outstanding, which would be there in your closing dump. So you should not accrue the entire interest for the 40, guys. You should accrue only the interest for the items during the year to the extent of only 30. And for the 10, you have anyways accrued it as a part of your closing balance outstanding. So you should not double accrue, guys. I hope you understood this, guys. So you have to ensure that the interest is not calculated again for the document numbers for which interest was already calculated in the open items listing. So you can do a VLOOKUP from here to ensure that the document numbers which are there in the open items listing are not again considered for interest computation in the during the year items listing. I hope this is very clear, guys. And formula for compound interest, very simple, guys. So you have to take your principal amount. So like basically, what is the formula for compound interest, guys? P into 1 plus R by 100, the whole power n minus P. Because P into 1 plus R by 100, the whole power n would yield you an amount that is inclusive of the principal amount. But we just want the interest component. So we will do minus P to just get how much is the interest component. I mean, what I am trying to say is, let's say P into 1 plus R by 100, the whole power n comes to 120. And let's say P is 100. Suppose you want to know how much is the interest in this 120. So this 120 would be bifurcated into 2 legs. 100 would be the principal component, 20 would be the interest component. That is why we are doing minus P, guys. I hope you understood this. So what the formula here would be principal amount into 1 plus 19.5% by 12. Why by 12? Because we want this to be in the number. We want this to be in the number of days terms, which is why we are doing it by 12 to first convert it into months. And again, this days we are again converting it into months. So what we'll be doing is principal amount into 1 plus 19.5% by 12, the whole power, number of days overdue. Let's say the invoice is overdue for 27 days. So you would do 27 by 30 here. And since you're dividing by 30, you're converting the days into months. And when you're doing 19.5% by 12, this is again getting converted into months. So everything is in similar terms. That is in terms of months. So your formula is mathematically accurate. And this is how you calculate this, guys. I hope you understood this. And this is how you arrive at the interest accrual that is to be done, guys. Perfect. Very clear. Yeah. Guys, again, so we understood how the computation is to be done and all of that. Now comes the interesting part, a part where you have to apply your mind. I have seen this disclosure going wrong in a lot of financial statements, but I don't want you guys to do this mistake. So here is the full disclosure of the MSME vendors, how you need to do this, how you need to get this perfectly right, how you need to be spot on with regard to this, guys. Yeah, right. Just coming here. So basically, if you have to see, Section 22 of the MSME Act prescribes the disclosure case. So just remember that this disclosure is not governed by Schedule 3. Instead, it is governed by the MSME Act itself. So you need to understand that this is flowing from the MSME Act, right? So first, the principal amount and the interest due thereon remaining unpaid to any supplier at the end of each accounting year. Okay, first let's take a look at the principal amount due. What is the principal amount due, guys? The principal amount due is basically the total of trade payable MSME vendors. And in addition to that, this is very important. This is a thing which maybe will tend to miss out. Your capital creditor MSME vendors also, because your capital creditors will also consist of your MSME vendors, guys. And keep in mind that even for your capital creditor MSME vendors, you need to accrue interest. Just because they are not trade payables, you should not be arguing that I will not accrue interest. They are, again, if they are MSMEs, you should accrue interest for them as well. Just keep that in mind, guys. This is very important. You have to accrue interest for your MSME capital creditors as well in addition to your MSME trade payables. This is very important. And interest due on the above. So what are they referring to here? What interest should we give here? So let's say the principal amount due is 100, interest due on the above. So we have 100 of balance that is outstanding. So they are asking, boss, you have an outstanding balance of 100 in relation to MSME trade payables and MSME capital creditors put together. So what is the interest that is getting accrued on the same? Let's say the interest that is getting accrued on the same comes to 2. That is what they are asking. So it is basically the interest accrual in relation to open items which the disclosure is asking you to give, right? Yeah. Next, the amount of interest paid by the buyer in terms of Section 16 of the MSMED Act 2006, along with the amounts of payment made to the supplier beyond the appointed date during each accounting year. So usually this will be zero in the client's case, because none of the clients usually pay interest to the MSME vendors. They just accrue and keep it in their books. They usually don't pay the amount. If they have paid interest to the MSME vendors, there would be an amount that would be coming here. So since they have not paid any amount to the MSME vendors as interest, the amount would be zero here in most of the cases. I hope you understood this case. Next, the amount of interest due and payable for the period of delay in making payment, which have been paid but beyond the appointed date during the year, but without adding an interest specified under the MSMED Act 2006. So basically, here they are asking us what is the interest in relation to cleared items. Like the cases where we pass entry, trade payables account, debit to bank, what is the interest you had to accrue in relation to those transactions, boss? That is the amount they are asking. Let us say we had a payment of 40 during the year on delay to our MSME vendors, on which an interest accrual of 3 had to be made. So that is the amount they are asking us. Basically, this is the interest in relation to your cleared items. Next, the amount of interest accrued and remaining unpaid at the end of each accounting year. So this is basically the total P&L charge of interest in relation to your MSME transactions, guys. So basically, this would be the summation of your interest in relation to open items, which is amounting to 2, plus your interest in relation to your cleared items, which is amounting to 3. So 2 plus 3, which equals 5, would be here. So basically, this would be the summation of this and this 2 plus 3. I hope you understood this, guys. Next, the amount of further interest remaining due and payable even in the succeeding years until such date when the interest dues as above are actually paid to the small enterprise for the disallowance as a deductible expenditure. So basically, they are just asking us what is our closing interest liability, guys. So how do we find this? So basically, in last year, you would have given this amount, right? So last year, this amount, let's say, is 100 basis your last year disclosure. This 100 plus your P&L charge minus your interest payment, if any made during the year, would be this amount. Since we have 100 of closing balance last year plus 5 of P&L charge minus 0 payments of interest, because we did not pay any interest to our MSME vendors, this would simply be 100 plus 5 amounting to 105. I hope this is very clear, guys. I hope you understood this. Yeah, so this is what I've explained. Basically, 4 is equal to 1 plus 1a plus 3, which I basically explained. Sorry, 1b plus 3, which is basically your interest in relation to open items, plus your interest in relation to cleared items, and your 5, which is equal to basically your previous year's closing balance, plus your total P&L charge for the current year, right? And one more important thing, guys, very, very important is, I just come here, just a moment. Just give me a moment, guys, just a moment. And just keep it in mind, guys, the interest in relation should be calculated only in relation to your micro and small vendors. So for your medium vendors, there is no interest calculation that is set out in the MSME Act. So this interest calculation needs to be done only for your micro and small vendors. So that is why I told you to be vigilant about the classification of micro, small, and medium vendors by the enterprises, guys. I hope that is clear. Next, forex gain or loss recomputation. Very simple, guys. Again, a very small concept. Let's just wrap this up. So let's say you purchased $100 worth of goods on March 10, 2025. Let's say exchange rate on March 10 was $1 is equal to 80. Let's say the exchange rate on March 31 is $1 is equal to rupees 82. The first scenario. So what has happened is basically the dollar has become stronger as against the rupee. So this would lead to a loss for you because you need to be shelling out more from your pocket than you initially expected. So the forex loss would be $100 into 82 minus 80, which would be rupees 200. So the entry you would need to pass in relation to this is forex loss debit to accounts payable. Let's say the exchange rate becomes 79 as at the year end. Your forex gain would be $100 into 80 minus 79, which would equal rupees 100. So the entry you would need to be passing against this is your accounts payable debit to your forex gain. So what you would basically do is, guys, you would basically do this for your foreign currency balances. So you would take each of your foreign currency balances, take the rate set out in your FBIL. So FBIL is now the authority that stipulates the exchange rate that needs to be followed, and RBI has also designated FBIL in this regard. So you have to take the exchange rate that is given in the FBIL side as at March 31, and you need to compare it with the exchange rate on the transaction date and compute the forex gain or loss for each of the balance classes. For example, if it's for pound, you need to do it separately for pound. For dollar, you need to do it separately for dollar, and you need to see that the amount is going correctly and the amount standing in accounts payable is correct to that extent. I hope you understood this, guys. So just and in relation to FEMA compliances for receivables and payables, I've already consolidated all the notes. We will do a detailed video surrounding the same soon. And for accruals also, I will do it as a part of a separate video. And in relation to search for unrecorded liabilities, again, that is in relation to accounts payable. That is a very interesting concept. I will cover that again as a part of a separate video, maybe along with accruals. Next, we will just come to some liability related transactions and the accounting with respect to the same. Before that, just give me a moment, guys. Just give me a moment. Yeah, just give me a moment. Hey guys, welcome back. So we were about to look at other liability transactions. So let's proceed to the same. This is the most interesting part of the discussion, guys. Don't miss it or else you'd regret it. This is going to be a very, very insightful discussion. So what are you waiting for? Let's just move on that. I'm just presenting my screen. Just let me know if once it's visible. Just a moment. Sorry. Yep, I think my screen is visible now. Perfect. Just hiding the controls. Yeah. Perfect. Just give me a moment. Yeah, guys. So let's take an example of this transaction, guys. Let's say you are the customer entity, and let's say you have a supplier abroad from whom you are procuring goods worth rupees 100. Let's say the credit period is 60 days, and let's say the purchase happens on March 30th. So basically, in this scenario, what you're doing is you are getting the pro forma invoice from your supplier and you're handing it to your banker, and your banker is immediately paying rupees 100 on your behalf to your supplier's banker. After which your supplier's banker, basically this person will remit that 100 to your supplier. So ultimately, and on the 60th day, you do not have a liability towards your supplier. You only have a liability towards your banker, because your banker has already settled your supplier, and you need to settle your banker because he settled the supplier on your behalf. I hope this is perfectly clear, guys. Okay, so let's just break this down into two scenarios, guys. That is, first one being the supplier bears the discounting charge. Let's say the discounting charge comes to rupees 10 and the supplier bears it. So there would be no impact for this discounting charge borne by the supplier in our books of accounts. So we will merely pass the entry for the purchases, right? We'll just pass the purchase entry, right? Very simple. Let's take the second scenario. Let's say the customer, that is the entity which we are auditing, bears the discounting charge. The scheme of entries, obviously the first entry that would be passed is the entry for purchases amounting to rupees 100. The next would be the entry in relation to discounting charge. Guys, if I just go up a bit, this purchase transaction occurred on March 30th. So basically, it is just one day before the financial year end, and the credit period is 60 days. So out of this credit period, only one day falls in the current financial year and 59 days fall in the subsequent financial year. I hope this is very clear, guys. So the accrual for the discounting charge should be made only in relation to one day and not for the entire 60 days. So this is how we basically need to be looking at the scenario, guys. So we have 10 of discounting charge for 60 days into one day in our financial year. So only rupees 0.17 should be accrued as our discounting charge, guys. I hope it is very clear. And so the entry which we would be passing in this regard is finance cost debit 0.17 to payable 0.17 for that particular financial year. Now a question would arise, guys. So where would this payable need to be present in the financial statements? Would it need to be taken to borrowings, or would it need to be presented in trade payables itself? If it needs to be presented in trade payables, what nomenclature would be giving for that particular transaction? I hope the question is clear, guys. Let's decode this now. So I will just give you two scenarios for this itself. Let's take the first scenario where there was no documentation on pen and paper regarding the supplier financing arrangement, and that the supplier basically went to the bank on his own will and he discounted the bill, in the sense that the normal transaction was to just pay after 60 days to the supplier directly, but the supplier was in immediate need of funds, due to which he went to the bank and he discounted voluntarily on his own will. That is the first scenario. Okay, I hope it is clear. So the second scenario, let's take the second scenario. Let's say the second scenario is that basically the customer, supplier, and both the bankers entered into a four-party agreement and were clearly informed about all the terms and conditions, and that the 60 days of credit period which they negotiated was usually higher than the industry credit period. Let's say the industry credit period was somewhere around 45 days. And let's say they formally entered into a negotiation with the four parties and they extended the credit period, due to which the customer entity was incurring a discounting charge due to the time value of money that was granted by the banker. I hope these two scenarios, these two cases are clear, guys. So just keep these two cases in mind. And now let's read a perspective about this, guys. Okay, so let's take guidance from the IFRS Interpretation Committee discussions plus Big Four papers that are available online. So you don't need to go and search anything, guys. I've already searched, done the background work, and I've consolidated everything here for you guys. So these are just indicative parameters, guys. So what they are basically saying is who negotiates the terms of the supplier finance. So if it is just the supplier who usually negotiates the terms of the supplier finance and not the customer, then it would be an acceptance which would be grouped under trade payable. So this is just indicative, guys. As I said in our first example, in our first scenario, the supplier voluntarily went to the banker and negotiated, and the customer was in no way involved in the negotiation. So that would most likely be classified as a trade payable and would be subject to other discussions as well. Why would it be classified as an acceptance under trade payable, guys? Ultimately, yes, you ultimately have a liability towards the bank, I agree, as the customer entity, but you initially had the liability to the supplier, and the supplier you are still in contact with the supplier, in the sense that you only got to know that your liability is now towards the bank and not the supplier because the supplier communicated the same to you. So the bank tomorrow will ultimately demand the amount of 100 from you. Yes, I agree with that. But they will also try to route the discussions through the supplier because the bank doesn't know who you are. So the supplier still exercises an element of control over you, the entity. Hence, it would be taken to trade payables. I hope this is very clear, guys. Next, what is the nature of the arrangement? That is the supplier financing also included in the arrangement? So in our second case, which we discussed, it was a four-party agreement where all the parties were aware of the supplier financing arrangement and they had negotiated the same. So let's say the four parties entered into the supplier financing arrangement because the customer was facing a cash crunch or was facing a liquidity crunch and was not financially doing well. And that was why they had entered into that arrangement in the first place. Then this payable balance, which is here, would need to be taken to borrowings. This payable balance here. I hope it is very clear, guys. Yeah, just coming down again. Next, is there an extended credit period by the bank? Yes. In our second case, as we discussed, there was an extended credit period by the bank. So it is an indication of borrowings, because the ideal credit period, which in our example was 45 days, but the customer entity was offered a credit period of 60 days, right? Next, whether additional security is provided, which wouldn't be if not for this arrangement. So the security part was not there in the discussion. If the security had been provided, we would have been more inclined towards the borrowing classification rather than the acceptance classification. I hope you understood this case. And in case of non-payment, who has the right to take legal action? Whether it is a bank or the supplier. If the bank has the right to take legal action, then we would be more inclined towards the borrowing classification of it. If the supplier has the right to take legal action, then we would be more inclined towards the trade payables classification part of it, that is under acceptances. I hope you found this clear, guys. Yeah. Okay. So this was a transaction which we saw in relation to supplier financing, specifically in relation to letter of credit, that is termed as LC. I hope you understood this, guys. Next, let's come to TREDs. So what is TREDs? TREDs is basically Trades Receivables Discounting System Platform, guys. So on 7th November 2024, the MSME MSME Ministry had issued a notification on November 7, 2024, mandating that all companies under Companies Act 2013 with a turnover exceeding 2.5 billion, as well as central public sector enterprises. So 2.5 billion, if I have to put it in terms, is basically 250 crores. Guys, they have to onboard the MSME vendors into the trade receivables discounting system. I hope it is clear. So if you are an entity who has a turnover that is exceeding 250 crores, you need to be onboarding your MSME vendors onto this portal. So the TREDs has a variety of portals, guys. Like RxSale is one of these portals, and other portals like M1 Exchange is one of the TRED portals that is recognized. Invoice Mart is one of the TRED portals that is recognized. So these are some of the portals that are recognized, guys. So the TREDs mechanism. So basically the TREDs is a portal where you will upload the invoice. That is either you as the entity, which is the customer, can upload the invoice, or your supplier, who is the MSME vendor, can upload the invoice. And there will be a financing institution, which can either be a bank or an NBFC, that will bid to settle this invoice. So you as the customer will select the financing entity that is offering you the highest credit period and the lowest interest. So basically, you guys would be having a doubt, guys. What is the benefit for each of these parties in this agreement? Why would the parties even enter into this agreement in the first place? So I will explain. I will use RxSale as a referencer here for our discussion purposes. I've seen this in one of our clients earlier, so I will be using that as an example here. So yeah, so basically, as I told you, the invoice is uploaded on the RxSale portal. Let's say the invoice value is rupees 100. Let's say the customer will upload the invoice, or let's say the supplier could also upload the invoice. As I said earlier, the RxSale would consist of banks and NBFCs who would bid to finance the transaction. The customer will select the financial institution who offers the least interest cost and the highest repayment tenure. Let's say the invoice value is rupees 100. What would happen is, let's say Bank A wins the bid. So what Bank A would do is, Bank A would immediately settle rupees 100 to the MSME vendor. Now what would happen is, the customer would settle Bank A on the due date. But in relation to RxSale, what happens is, what we saw in one of our clients was that the interest had to be paid on day 0 itself, but the principal had to be settled after 180 days. So that was the scenario which was happening in our example, guys. So now let us look at the advantage for each of the parties. So the customer gets the higher credit period as against transactions with MSME, where the maximum credit period was 45 days. Because as I told you in this example, guys, you could get up to a credit period of 180 days in RxSale. Yes, you would have an initial interest outflow. I agree with that. But at the end of the day, you are getting a higher credit period, guys, and your principal amount is not getting locked for a long while. So you are getting credit period of 180 days as against a 45 days from the customer standpoint. For the MSME, they don't have any difficulty in collections, and they don't need to be worried about aged receivables. They get the opportunity to collect the amount immediately, which is very clear. I hope you understood this, guys. And the financial institution earns interest income. As I told you in our example, in relation to RxSale, the interest had to be paid on day 0 itself. So the financial institution would also have a good cash flow because of this, and they would be able to earn interest in relation to the same. I hope you understood this, guys. And as I told you earlier, in RxSale, the credit period availed by one of our clients was 180 days. And the interest rate was 6% per annum. However, the interest was required to be paid on day 1. That was the slight limitation that was there. But apart from that, this was a very good mechanism. So let's take the entry flow in relation to hypothetical transactions, guys. Let's say the invoice amount is 6,000. Let's say there is interest at 6% per annum. So interest at 6% per annum, if I take, it would come to rupees 360 for 12 months. But our credit period is only 180 days. So it would be rupees 180 for 180 days roughly. And let's say this transaction happens on March 1st. And let's say this scenario happens on March 1. So journal entry on the day of the transaction. What would be the journal entry, guys? So the journal entry that would be passed is expense account debit 6,000, prepaid interest account debit 180, to bank 180, to RxSale 6,000. So your expense would be debited to 6,000. If I have to break this into two entries, the entry would be expense debit 6,000 to RxSale 6,000, prepaid interest debit 180 to bank 180. Then you would take a portion of this prepaid interest to P&L. So before that, you guys would be having a doubt. Boss, we told to RxSale here. Where should this be present in the financial statements? Again, let's go back to scratch. Should this go into acceptances or should this go into borrowings? Ruko zara, I will explain this. Again, we will decode this using our framework which we had above, and let's discuss this. So now a portion of the prepaid interest has to be taken to P&L. So rupees 180 is the interest for 180 days. And if we take that for 30 days, we would have an interest cost of 30 for the financial year, because the transaction, as I told you here, was entered on March 1st. Right? Yeah, that's very clear, I hope. And so the journal entry for the interest cost would be finance cost debit 30 to prepaid interest 30. So ultimately, your prepaid interest in your financial statements would be now at 150, and your expenses would be 6,000 plus your finance cost of 30. 6,030 would be going to your P&L. Your prepaid interest would be standing at 150, and your RXL would have a credit of 6,000. So the point of discussion here is, where should this RXL balance be taken? Final verdict. Okay, now I'm telling you the answer. It should be taken to borrowings. That is our point of view, that is our perspective, and that is what a few people also agreed upon. And let us understand the reasons for this. But yes, there are still companies and firms who take the stance of taking this to acceptances or to trade payables directly. But our perspective is that it should be taken to borrowings. And let me enumerate as to why it should be taken to borrowings, why borrowings is a better stance. Guys, first, very simple perspective. Let's just go above to our conditions. Right. So here, if you see who negotiates the terms of the finance. So here, both the customer entity and the MSME entity are aware of the RXL concept, and all the three of them are willingly entering into the transaction. That is the banker on the RXL platform, the customer, and the MSME supplier. I hope that is clear. What is the nature of the arrangement? So the nature of the arrangement is not because the financial difficulty of the customer. So it is basically in the nature of supplier financing. I'll tell you why. Because there is an extended credit period given. Because in relation to MSME vendors, the maximum credit period that the entity could have availed is 45 days. But they're getting a credit period of 180 days, for which they are also incurring an interest cost. So it is out and out a financing arrangement. And moreover, the entity, that is a customer entity, does not have a liability to the MSME vendor right now, because the liability to the MSME vendor has already been extinguished, because RXIL has already settled the MSME vendor. So we have the liability towards the banker or the financial institution on the RXIL portal, and not to the MSME vendor. And we are also availing a credit period that is higher than usual towards MSME vendors. And we are also incurring interest costs for the time value of money. Hence, it should ideally be classified into our borrowings, guys, into our short-term borrowings, because the credit period is less than 1 year. It would be a short-term borrowings under your current liabilities, under your current classification. I hope that is very clear, guys. Yep. So next, there is another interesting transaction in relation to RXIL, guys. I'll just come to that. So yeah, just a moment. So before this, I just want to explain one thing, guys. Let's say you received an invoice from your MSME vendor on, let's say, March 31st. Let's say you uploaded the invoice on the RXL portal, or let's say your MSME vendor uploaded the invoice on the RXL portal, let's say on April 3rd. Guys, as at March 31 on the balance sheet date, you would show this amount under your trade payables only under your MSME classification, because because the MSME ministry has only told about the onboarding part as compulsory. There is no hard and fast rule that the settlement has to take place through the RXIL portal. You can even settle off the RXIL portal, or you may upload, or in our example, we uploaded the invoice on April 2nd, which is after the financial year end. But as on the financial year end, your liability is towards the MSME and not towards a financial institution on the RXIL portal. So as on March 31, since your liability is towards the MSME vendor, and since the invoice has not yet been uploaded on the RXIL portal, you would show the amount to that extent under your trade payables MSME classification. I hope this is very, very, very clear, guys. Yeah. So next, just coming down. Next, hypothetical transaction in relation to RXL. So let's say a financial institution onboarded on March 31 onto RXL sanctions rupees 1,000 to the MSME vendor. What entry needs to be passed? So basically, on March 31, a financial institution or a banker who was onboarded on March 31 gives an advance to the MSME vendor. What entry needs to be passed in this case? You guys might be like, boss, they're giving an advance to MSME vendor. How is this going to affect us, boss? Why do we even need to pass an entry? We are not even a party to this. No, guys, that is not how it works. Ideally, an entry needs to be passed here. Let's decode what entry needs to be passed here. So basically, we need to pass the entry advance to suppliers account debit 1,000 to RXL account 1,000. And hey guys, sorry, there was an audio issue. I'm just representing my screen and continuing from where we left. So just let me know if my screen is visible. Yep, I think my screen is visible now. Just a moment. Yep. So guys, as I was saying earlier, the entry that you would be passing is advance to suppliers debit 1,000 to borrowings 1,000. So let's discuss the logic for this, guys. So basically what is happening is, this is indirectly a scenario where we are indirectly giving an advance to our MSME supplier, and we are indirectly taking a borrowing from RXL. So why am I saying this, guys? So let's understand this. Just a moment. Just zooming in a bit. Yeah. So basically, how do I decode this logic? So let's say you have taken a borrowing from RxSale and using the funds of that borrowing, you're giving an advance to your MSME supplier. So what would the entry be in such a scenario? Bank account debit to borrowings. Then when you're giving an advance to your MSME supplier, you would pass the entry advance debit to bank. So many of you might say, why can't we knock off an asset and liability? Guys, please understand that the borrowings is towards RxSale and the advance is to your MSME supplier, and both of these are different parties. So you cannot knock off them. In the examples where we knocked off, be it our capital creditors and capital advance, or be it our trade payables and advance to suppliers, they were in relation to the same party, which is why we basically knocked them off. So here, if you see here, bank account debit to borrowings would be the first entry for the loan from RxL. Then it would be advance to bank for the next entry for the advance given to our MSME supplier. So net, if you see the impact, the entry would be advance debit to borrowings because your bank in the debit and bank in the credit would get nullified, right? So let's say the MSME vendor enters the service on April 3rd after the financial year end. So you would pass the entry expense debit, then you would take the credit to advance to suppliers for 1,000 because the advance in relation to which you had given is getting utilized now because the service is availed now after the financial year end. I hope you understood this. Next, if I just come down, then on the due date, that is after 6 months, when you repay the amount back to RxL, you will pass the entry borrowings account debit to bank. Guys, I hope you understood this. I hope this was a very, very insightful session. And I'm sure the last part of the session would have been an insightful ride for sure. So guys, if you like the session, please do support the session. Please do please do subscribe to the channel. Please do support to the channel. And if you could share it to someone who is in need of this, it would do a lot of help. So please do keep learning, keep growing, and do support, guys. This fuels me to work harder. And a lot of amazing content is on its way. And your support makes me work even harder. Thank you so much, guys. Cheers. Keep learning, keep growing. Thank you.